going here in about a minute, so really close.
You're lucky.
Video's going, just give me 1 second and we'll get started.
Yeah, shoot me all that and then let me
Alright, let's go ahead, we'll get started. I know everyone wants to do some different things. Let me make sure Donald says we're good. Are we good? He was already recording me. You'll edit all this bad stuff out and start, okay. No, I'm just kidding. Alright, for those of you who don't know me, hopefully everybody does by now, but if you don't, my name is Phil Massey. I'm with Assured Partners, and I'm the insurance agent for the Century Village West Palm Beach Insurance Program. This is our 4th year doing this. So for those of you who've been with us the last 4 years, it was 2022's renewal, 2023, 2024, and now we're going into 2025. I hope everyone will say and agree that our process has only gotten better each year, and we've gotten smoother. That first year was like, oh my gosh, it's crazy learning how to do this. So we've come a long way, and I'm going to introduce everybody here in a second. So today, I'll introduce myself in a little more depth, the team. I'll talk about the insurance market a little bit, and then we'll get into the option sheets and roll through it. Some quick housekeeping things. This whole thing we're doing today, which maybe this runs about an hour or so, will be recorded and will be on, I believe, the Yuko TV channel. So I'll be playing overnight, 24/7, until everybody here wants to shoot me. But that'll be out there for you as well to consume. Plus, our team has already pre-recorded a link that is just me going over the option sheets, and that goes on for about 20 minutes. So it's an abbreviated version that just focuses on the option sheet. So today, if you leave here with questions or you want to refer back to something, you just email the email address on here and we'll send you the link. Yuko has the link as well. So we've got a link of me walking through this. This thing's going to be on video, plus you're all here today to consume it that way. So a lot of different ways to get this to people who can't be here physically or need something to refer back to. Also, tomorrow and Wednesday, we will be back here from 12 to 2. We will not be doing this presentation again, but we will be here to answer questions and take back your option sheets or help provide more option sheets for folks that couldn't make it today. So, quick introduction into myself, since you've probably heard this a few different times. I've been an insurance agent for 19 years, which is hard to say. It seems crazy. I know I look so young and youthful, but not this morning. I don't feel it this morning. You see me sucking down this culotta down here. Let's keep bringing this up for energy. And then I don't know that this is 100% factual when I'm on video, but I believe it's true. I insure over 1,500 condo associations in the state of Florida. That I know is a fact. I'm pretty sure that's more than any other agent in the state of Florida by a good margin. Now granted, 300 of them are here in this room, but still 1,200 different associations out there. So I believe I'm the largest insurance agent for condo associations in the state. We have a team of 26 folks, which I'll get into in a minute, that helped me do that. But again, when we got into this 4 years ago, it was bringing someone who's a specialist in the community association world, which was kind of huge for you guys to go through that process. I'm heavily involved at CAI, Community Association Institute, for good or bad sometimes, but I was a member of the Surfside Response Task Force here through the state of Florida after that occurred, past president of our Central Florida chapter. I've taught and spoke at multiple CAI national conferences and law seminars. I have my CIRMS designation, which stands for Community Insurance Risk Management Specialist. There's only about 10 of us in the state of Florida and about 100 around the country. And that's the highest designation an agent can get to specialize in community associations. Also a CEU certified instructor for the CAM license. I teach, I have 8 different courses that we have built and teach. If you guys have probably seen me on some of those. I know Donald's hosted some meetings where they had the whole thing up and shown out there for you guys, and it's also been sent out through Joanne. If anyone needs any of those CEU classes that I've done, condo water damage, vendor risk transfer, slip and fall prevention, any of that stuff, you can always email us. We have a lot of this stuff documented in library form. We can send you those links. So that's something else to know that's there. I'm also the current board member for 2 large condo associations, a 299 unit and a 190, actually 290 and a 199. I was on 4 boards at one point, so I've peeled back some. I think I always make this joke to you guys, but I don't know, I go to 300 probably board meetings plus a year in person or remotely, and so I don't know what I did in a prior life to deserve it, but I'm sure it was terrible, bad things. And then introduce my team real quick. So we have 26 employees on our team back at the office that help us do what we do here today. But I want to introduce everyone that's back there because I think this is important. So Christy Lawrence is the superstar of the group, right? So she's waving. Wave again so everybody knows Christy. You probably know Christy because Christy actually works with Mike and Suzanne in the UCO office Tuesdays and Thursday mornings, which is a huge commitment for her because she's the claims analyst for our entire book of business. So she's taking and dealing with hundreds of claims a month. I mean, how many open claims do you have right now, Christy? About 600, right? So not on your account, 600 on our book of business. But think about that, 600 slip and falls, fires, whatever there might be. And so Christy runs that whole thing. She has a team that helps her, but she's actually here on site. She's walked this property, she's intimately knowledgeable on it. So it's a really big resource for you to have somebody like Christy that's here. Jenica Mandarano. Jenica is the account executive on this account, so she's running the day-to-day. Jenica is also the office manager of our office. She's our most talented and greatest AE, and she is here on your book of business, or this account. So very lucky to have Jenica with us, and she also keeps the train on the tracks when it comes to running all this stuff. She's very organized, which is a great thing. Better than me doing it. And then Jess S and Jess C, so the Jesses over here to the left, they are returning. They were here the last few years too, helping us, and so they're back. They are also account executives in our office and help us with various things, but they are bodies to help us today, which is really useful. And I will say, we had Elma last year, if you remember. Elma is not here this year because she had a baby. She's out on maternity. She comes back in January, but filling in for her is Jillian. And Jillian's a name you might hear as well because she helped us keep track of all the Century Village roofs, which I'm going to get into in a minute, the carrier inspections, the 3-story condos and their needs. So Jillian's intimately involved in the account as well, but it's her first year here, so we're welcoming her to this. And then last but not least, Esther Santa Maria, which I'll talk about her more in a minute. Esther's not on our team, but she's with Custom. That's K-U-S-T-O-M. Custom is the disaster remediation contractor, emergency disaster contractor that we got UCO to enter into an agreement with this summer prior to storm season. So we'll talk a little bit about her. But Esther has been around a long time. She was a high-rise manager for years. She's very involved in community associations before her recent move to Custom. Quickly on Assured Partners. Assured Partners is about the 10th largest insurance agency in the country. We've got operations in 40 different states, 4 different countries, 10,000 employees. Corporately headquartered in Orlando, but it's a very large organization, so not something that it's just me and my 26 people. We're part of, obviously, a very large agency, which is the point there. All right, so quick overview. Century Village, again, 2022 is the first year here. I don't know, I'm happy I'm here, don't get me wrong, but we picked up this account at like the epically craziest time of insurance, right? So 2022, we were here in the end of 21 doing the first presentation. The insurance market was bad, right? It was not in a good place, but it was getting worse. So we were trending negatively. We delivered the speech in 22 and did the for that year. Then 2023 came. 2023 made 2022 look good. 23 was the worst insurance year on record ever for the state of Florida. Not 20 years ago was worse, or 50 years ago was worse. Worst year ever, okay? And you all lived that. You saw that with the rates and the deductible increases and all the crap everyone had to go through. It was bad.
And in January of 23 was probably like the pinnacle of craziness because no one knew what was going to happen. This master program that we have here for Century Village is the reason we were able to keep this thing on the tracks. Individual associations or individual condos that didn't have the power of the larger program really got steamrolled in this market. And I know it feels like you did too, but much, much, much worse on a different scale. And we know that because again, I got 1.2 thousand condos outside of this that saw how bad that was. 2024, if you remember last year, we came in better than projected. So it still was an increase, but the terms kind of flattened a little bit, and we came in better than we budgeted. So the middle of this year, so the middle of 2024 is when we kind of saw the market start to change. And now the 2025 renewal, the one that I'm going to be going over with you today, I mean, it's finally good news. So we're going to see no negative changes in coverage, improvements in coverage, reductions in deductible, and then a reduction in overall premium and rate for a lot of associations here in the same option they chose year over year. So I'll get into that, but we've now turned the corner. And the reason we were able to do that, and I'll tell you why in a minute, is just kind of the power of the program. So to give you an idea, I had recommended to everyone here back in August to budget a 10% overall increase. That's what I recommended to you guys. Remember, we didn't know what was going to happen with storm season. Then what do we have happen? We get Debbie, Category 4 storm. We get Helene, which again was a flooding issue more than anything, but massive destruction through the Appalachia area after it went through Florida, in the same area. Those poor people got hit with 3 storms in 12 months. And then we had Milton, and Milton was really the big impact for everybody from a Florida perspective, because Milton was it could have been worse, so it wasn't as bad as it could have been, but that was a wind event for us, and it hit a very populated part of the state, and so we dealt with a lot of claims and issues from Milton. But despite all that, the market overall was still improving because of the laws that have been passed, because of some of the changes, reinsurance costs were coming down. So we got a little, hey, we thought we were going to do better than 10%, but we didn't want to tell you guys to budget less because obviously then we don't want to blow it up if we can't deliver. Ultimately, we were able to come in much better than that. So there is going to be a range here. There will be some associations that are sitting here today that their same option year over year is up 20%. And you may look at that and say, well, what the hell, Phil? That's different than what you're saying. The reason for that is there's going to be some associations that had roofs that were, let's say, 14 years old, and they've just now crossed the barrier, right? So, and I'll explain this in a second, but the roof could have gotten older. That's why the rates went up. There's also going to be some people sitting here that have massive decreases of 28%. That's basically the range. And those will be associations that likely had an old roof that have replaced it. So now they have a 2024 roof, it says that on the top left of your sheet, and they're going to be seeing significant decreases. So the budget was 10%, one size fits all. We're likely better than that for 90+% of you, and then a lot of you are going to see decreases too. So premium perspective, no bad news. Overall, we're driving over a $700,000 savings collectively to the program. So now again, some of you are seeing small increases, decreases, but well over $700,000 in overall cost coming down for all 300+ associations. And again, the reason we're able to do that is the power of the Century Village Master Program. And so, you got to imagine, if you're a standalone 24-unit, $2 million condo versus being part of a 7,500-unit, $700 million plus kind of behemoth, it protects and hides people in here that maybe have older roofs, have had claims. You may be getting dinged here, but if you were out on your own, it would be significantly worse. And so the program helps. And it gets everybody kind of renewed together, because at the end of the day, a third of you, the associations here, don't even sign an option sheet. So it keeps everybody insured and on the right track. So we look at protecting that program. What do we need to do? And so for the last 4 years, this is something that I felt like we changed the conversation on and came in here and said, how do we make this program look better so it's kind of best in class and keeps the rates controlled versus what's happening outside of the program? And so a few things I mentioned, and I'm going to give you updates on them. One was the roofs. So if you look at it, in this program, we have 334 separate roofs within the Century Village West Palm Beach program. 334. It's a lot. So you have some associations that have multiple buildings, and then a lot of you are single building roofs. When I first started here, and these numbers are estimates, but if you looked at roofs that were 15 years or newer, there was only about 100 of those 334 that were within the last 15 years, which is less than a third, right? I'm proud to tell you today that 78%, 262 of the 334 roofs have been replaced in the last 15 years. So that's credit to you guys, to UCO, to just getting that stuff out of there. These 20-plus-year-old roofs, getting them updated, that really helps our program and our ability to negotiate when we can show that improvement year over year. The roofs that are 16 to 20 years old in age, those were, back in the day, 171 roofs here were in that frame, in that time frame. Now it's only 23. Think about how much that's reduced. The only class that's gotten more is the roofs that are older than 21 or older. Those went from 26 to 49. And I think the reason why is that you still have, basically almost 40 plus associations here that have old roofs, 20-plus-year-old roofs, and really no plan. Some of them have roofs that are 20 years old and they're in good shape and they know that. There's others that just haven't gotten around to putting forward the work that needs to be done to get them replaced. So again, not judging anybody, but again, that's grown because, like anything else, there's 300 plus, roofs. There's going to be a fraction that continue to age that don't get replaced. So thing to think about. Next is the electrical system. This is something we talked about over the years. These buildings were originally built 50 years ago. The electrical requirements 50 years ago were a lot different than they are today. So if you're one of the buildings here that still has the original electrical box, like from the side of the building, like the Federal Pacific panels, that's what it used to be, or the Sylvania or Stamlock breakers, all that stuff is unfortunately, it's bad, right? We're not hitting you for that. If you have that versus an association who's updated it, there's no difference in how you're being rated on this. But collectively, when we go out to the market to shop the insurance, that's a part that's tough. Because some carriers cannot write risks that have those older panels. It's a reinsurance treaty issue for them. So they deny the account because they can't pick up the buildings that have that. And we have to fracture the program, which would make it difficult, basically take away from what we're doing. So that is something that I would recommend everybody here have an electrical inspection, look at what the situation is with the electrical system. If it's in great working condition and the electrician says you don't have to do anything, so be it. But I would recommend at least updating that electrical panel to the most recent panels. And so I'm on 2 boards of directors, one of which is for a 1973 condo in Orlando. And we're going through this right now on our 20 different buildings. So 11 of the 20 we've updated the panels on. We're still trying to do it on the other 9. The problem with updating the panels, so everybody understands here, it's not easy to get the panels. It takes a long time. We're on back order for 6 to 9 months. So if someone said right now, you got to replace your panel next week, no one's doing that. So it's something you have to plan for. And it's not cheap either, but it's getting the stuff that's actually the tougher piece there. So I just mentioned that because it is something that you, just again, to make it a better overall risk. And again, at the end of this, I'm going to take questions and stuff, so don't feel like you're not going to be able to go back on any of this. And the other big thing is the phase 1 inspections and the structural integrity reserve studies. So by a show of hands here, anyone here in a building that is 3 stories or taller? Okay, so we have 19 of associations here that have 3 stories or taller buildings. For those of you that have 3 stories or more, and if you're under 3 stories, you can just shut your brain off for a second, if you haven't already, listening to me. But the 3-story buildings, those, per the new Florida statute, are required to get a structural integrity reserve study and to get a phase 1 structural inspection. This is all post-Surfside fallout. We've done classes for you guys, we've brought in vendors, I've been on the TV talking about this stuff. The due date to have that stuff done is 12/31/24, so a few weeks from now. We do not need that for this program right now. So our carrier is renewing you without you needing to have that. So don't panic, but I do want you to look into finalizing that next year because only about half of the 3 stories here have done that. And that's concerning because Citizens, and you guys understand what Citizens is the market of last resort for property insurance in Florida. They put out a press release a few weeks back that said the new rule in 2025 is that any account that wants to get a quote from Citizens or renew with Citizens that is 3 stories or taller and 30 years or older will have to have both of those reports in the Citizens and accept it. So if Citizens is doing that, other carriers are going to follow suit. So our carrier next year may very well implement a requirement that any of our 3 stories that are fitting those characteristics have to have the report, and it has to be acceptable. Now, whatever leverage we can do because of our size, we'll do it, but it's something that would definitely help to have that looked into. Okay, so that's all the housekeeping stuff. So now I'm going to get into what's different year over year. And so as I mentioned, nothing, and this is the easy thing for everybody to understand, nothing I'm going to talk about today, nothing happening in the new program is worse year over year than it was last year. Everything's as good or better, okay? So there's no bad news. No coverage, no deductible, nothing changing negatively. But right now I'm going to focus on what have been the positive changes in the program, because none of the changes, again, are negative. The very first thing is that the property values have increased by 5%. So if you had your last year option sheet and you're looking at the new option sheet, the values that you're insuring your buildings for have gone up by 5%. So everyone in here is going to see a 5% increase in value. So by itself, that usually lends itself to a 5% increase in premium. We've been able to negotiate a rate decrease that's below 5%, which is helping offset that. But that is something that every 3 years, UGO does an updated insurable value appraisal, which is actually due next year, so we'll be getting a new one. We expect that appraisal is going to increase the values, but the carrier is requiring us to go up by 5% this year because we know our price per square foot is low on these buildings. And so they're requiring that bump. That will make next year easier, because if it goes up by, say, 10% on the appraisal, and you've already done half of it, you're kind of stair-stepping that a little bit. But that is a positive difference, so up 5% year over year in the values. The next thing is on the hurricane deductibles. Last year, the hurricane deductible was a, whatever percentage you chose, last year was 3, 4, or 5, it applied per building per storm. So if we got hit with multiple hurricanes, it was 5%, 5%. Every time a storm hit, it would be a separate deductible. This year, that's been improved to a calendar year aggregate deductible. So if we get hit with 3 hurricanes again, like when Gene, Francis, and whatever the other one was, Charlie, granted, not all of them hit you here, but they did crisscross the same point of the state. And you've seen the Big Bend area get hit with multiple storms. If you guys got hit with 2 hurricanes in the same year, it would be 1 aggregate deductible per building, not a different deductible for each storm. So that was a nice improvement in the deductible. The non-hurricane deductible also improved. It was $10,000, it's still $10,000, and that's anything that's not hurricane related. But previously it was $10,000 per building. This year it's just a flat $10,000 per occurrence. That really doesn't matter for day to day, because if you have a pipe burst in your building, it's not affecting the next building. But if you had like a tornado that came through, or a hailstorm, or a fire that somehow damaged multiple buildings, it would limit that deductible to just 10 grand instead of 10 grand for every building. So it is an improvement, it's just, not on a day-to-day basis, it's not a great thing. It's a positive thing overall. Co-insurance, we also were able to negotiate an improvement in co-insurance. Last year, the co-insurance was at 100%. 100% is the worst co-insurance. It means you're required to be insured to 100% of what the actual replacement cost values of your building are. And even though you're insuring 100% to the appraisal, we all know that doesn't matter. You see what inflation does. The values could absolutely be higher. And it gives the carrier wiggle room at the time of loss to hit you with what we call a co-insurance penalty. So we don't like 100% co-insurance, but we didn't have a choice. In the prior markets in the last few years, you didn't have an option. It was 100%. This year, we were able to get them to reduce it to 90%. This requires you now to insure 90% of the building value in order to get 100% of a smaller claim. So you have a 10% margin of error, essentially, in the valuations. That is much better at the time of loss for the association. So that's a good thing. So it's a nice improvement. The hurricane deductibles from the percentage perspective have also improved, and I'll go into this when I go over the option sheet. Last year, your option was a 5% at option 3, 4% for option 2, and a 3% for option 1. That is now 5, 3, and 2. So we were able to reduce that. So if you remember when I first came here, if you've been doing this for several years, it used to be 3%, 2%, 1%. And then the market blew up and that was impossible. And so it changed from 5, 4, 3. This year it's going to 5, 3, 2. So you can see the improvements there. And I'll go into all the details on that. But if you look at, like I just chose a random Wellington. So this Wellington Association is insured for $5.4 million. If they have a 5% deductible, that means that building's deductible is $270,000. It's not a small amount. If they chose the 2% option, that's a $162,000 reduction in their deductible. It moves it from 270 grand to 108,000. So that's a significant reduction. That's $4,000 assessment per door reduced to take that lower deductible. When the market hardens, like it did the last few years and the rates go up, that's when people will trade the higher deductible for the savings, because you get more bang for your buck. But this year, with the rates getting better, we were able to negotiate a killer deal to go to that 2% deductible. So I would encourage you that if you budgeted, let's say, a 10% increase, you may still be able to go to the 2% deductible and it'd be flat year over year, or only up a few percentage points. Especially if you have the older roofs, you absolutely should take advantage of that. So I would highly recommend looking at the 2%, that option 1 this year, because you're going to get the most bang for your buck versus what the rate is. I can also tell you that no association that doesn't participate in this program, so the non-participating associations here, or any condo that you run into with the age of these buildings in anywhere in Tri-County, has less than a 5% deductible, because these carriers aren't doing that. But because of the size of our program, we're able to negotiate buy downs that are very positive. That's why you're able to see that 2% and 3%. You would never get that on your own. So it's something worth taking advantage of. So 2 more quick things. Also, we added this year a new insurance coverage that you've not had ever in the past, called the legal defense cost policy. The legal defense policy is something that started to become popular 6-7 years ago. It came into the market, got more popular post-COVID. But what that does is that if you have at your association, you have a claim that pops up and it gets denied on your general liability policy or your D&O policy. And there could be reasons why. Even though we try to cover everything, there's still going to be exclusions. There's still things that can have an excluded claim. Right now, if your claim gets denied, you have to hire your own attorney and you have to pay defense costs per the association, right? I've lived this as president of a board where it was costing us up to 50 grand a month to defend ourselves in a big suit that was uncovered by insurance. Now it's a bigger association, but still, it can be very expensive. This policy is like sleep at night coverage. It comes in and picks up the defense cost unlimited through trial for you guys. So it's like having an attorney on retainer. They basically come in, they defend your case in the event that it's not covered by the insurance program, and it prevents you guys from having bigger assessments and costs that are inflating. I've had this work for my associations where they had that attorney end up getting them out of it, so they didn't have to pay anything, and then the legal costs were covered. We got a very, very good deal. It only cost us several dollars per unit to get this done a year. You would have never been able to negotiate the same thing. It would cost you 3 times as much if you bought that program on your own. So it made a lot of sense to bring that to you all this year. Also, we were able to negotiate with them 25 hours of free legal advice. So every association here doesn't have 25 themselves, it's a pool of 25 hours. But that 25 hours, if you guys have any type of legal question and you don't want your attorney to bill you your $300 an hour or whatever to ask them, I wish I could bill like an attorney. We don't bill at all, obviously, so we don't have to hear on my own. But you guys, if you had to go to your attorney and they would cost you money, you can actually call the legal defense hotline that we have, and they give up to 25 hours collectively. Remember, I know we probably would need more than 25 hours for all of you ultimately, but this was a throw-in and it was part of the negotiation. I think that if we run up against that 25 rather quickly, we'll probably be able to get more. And I think next year we'll gauge how much you guys use, and then we'll get more in the next year negotiation. But for this year, that is available. That is new. Never was available before to you. So we'll see how that goes, and we'll provide you the phone number and the link and all that for you if you need it. The last difference year over year, and again, another positive, is what I mentioned and introduced earlier for Esther. So coming up to storm season this year, we realized that this association, this program, one of the big issues or deficiencies was that we didn't have a contract with a restoration company that was capable of coming out here post-storm and addressing the issues that you're going to have. And you got to think about that for a second. If you look at Hurricane Dorian, you guys remember that monster that was sitting outside just crushing the Bahamas? That thing was like latitude was like kind of right there with West Palm. Had that thing kept coming instead of like putting the brakes on and turning, I mean, every day I looked at that like, oh dear God, please no. If that came on shore here, we got hit with that hurricane, you got to think about the time of chaos that would kind of occur here, right? You have 334 roofs, of which a storm like that's impacting all of them. But let's just say it impacted a third of them even, and you're looking at 110 roofs that need tarping, that need potential, emergency service. You've got water coming in through the building, needs to be dried out. You have windows that need to be boarded up. All of this stuff needs to be done on an emergency basis. You can't wait for the adjuster to come and deal with it. You need that water extracted. You need that building protected. It's actually required by your insurance policy that you do that. Up until this year, that was really on you guys. There was no, and do you really want the board to be opening the yellow pages and trying to figure out who to use at the time of loss? Not only that, but if a storm like that comes through, the equipment, the manpower, none of that stuff's guaranteed for you guys. So we got into a contract with Custom through Esther that is bringing, and again, this costs you nothing to do this, so this isn't like some big crazy gotcha cost, but this obligates Custom to Century Village West Palm to make sure when that storm's coming that they have the equipment held and it's going to come in post-storm, so they've got the manpower, the equipment ready, they already have the specs of the community, the specs of the buildings, and they can get to work immediately and help work on this stuff. Because it's the one thing that's kept me up at night over the last few years is not having something like that in place, because the nightmare that it would be to deal with it was significant. And so I'm very happy we kind of got over that hump, and UCO agreed to go along with that. That was huge, good for them to do that, because I think that's going to be very beneficial. Hopefully we never have to use it, but Esther's going to be here afterwards. If you have any questions for Esther, she wanted to come show face and be here in case you guys had questions. But that's going to be very important for us if that ever happens. And no offense to Esther, but hopefully we never have to see her or use that program going forward. So that'd be good. All right, so now the option sheet breakdown part. So again, as I mentioned before, this stuff, we have the recorded link, which we can email you to kind of go over some of this in detail. But I'm going to go ahead and walk you through one right now to help you guys make the decision that you need. So everyone should have one of these option sheets. I'm assuming you guys can't see this, but it says Assured Partners at top, 2025 insurance premium allocation by association. Make sure yours says 25, because if you're looking at your 2024 one, that's obviously last year. 2025, if you look at the top of that sheet, and does anybody right now not have that sheet? Just make sure, because if you don't, they're right back there. I didn't know if anybody walked in and didn't have it for some reason. But all of them are back there if you guys need to get up and grab it. The option sheets are due, so you need to make a selection by December 19th at noon, okay? December 19th is the same cutoff date we've had for the last 4 years. So it's not that we're doing that any earlier or any later than we did before. We have to do it by the 19th, even though the policy doesn't renew until the 1st, because we need time to finalize the program. So hopefully everybody understands that. So you can turn them in today, you can turn them in tomorrow, Wednesday, and you will see here, you can email it or bring it by the UCO office at any time as long as it's before the 19th at noon. That email address that's on there is the email address you would send it to, or again, providing it to Mike, Christy, or Susan, or their team there at UCO. If you look at the top left, you'll see the association name. That'll probably be whatever your association is. Obviously, make sure that's your association. If you live in Andover A and you're looking at Andover R, whatever that even exists, Andover B, C, that's not a good thing. So you want to make sure that's your association name on the top left. You go to the right, that's the units. That's the number of units in your association. Again, that should match. If it doesn't, obviously let us know. The property manager on the far right, that is the number, that is the name of the management company that's supposed to be in place as of January 1st, 2025. So Seacrest and Pruitt are the two big ones, but you guys might have some self-managed in here, some different management companies. Make sure the name is correct there. If it's not, let us know, we'll update it. The prior term option chosen. So this is really important. If you look here, the one I have in front of me says option 2/finance. The two things you have to decide on is which option you want and how you want to pay for it. If you look here, you'll see what the option is you chose last year, option 1, 2, or 3, and how you paid for it, pay in full or financed. So if you want to know what you picked last year, you look here. So the one I'm looking at says option 2, so I would move to the middle, which is option 2, and that would be my same kind of year over year from a premium comparison. And then I can obviously go to option 1 or option 3, which we'll talk about in a second. And then the prior term premium. So that premium on the top right, that is the premium that you paid last year. So when you compare those premiums at the bottom of the sheet, that's going to show you, is it going down year over year? Is it going up? Is it staying about the same? And obviously it depends which option you choose, which we'll talk about in a second. Then the roof year, this is important. So this one I'm looking at is a 2024 roof year. If yours says 2024, that means you've replaced your roof this year, which is great. That's going to be the biggest benefit year over year to those associations. If your roof, we're looking at 2025 policy. So if you go back 15 years ago, that would be, 2010. So any roofs that are older than 2010 are going to be, between 16 and 20 years old. Anything older than 2005 is going to be that 21 years and older. So if your roofs are prior to those dates, those are the ones that are getting the rate ding, if you will. The mid-year, that was your wind mitigation year that you provided the mitigation report for. The big thing to remember with the mid-year is that you want the year that it's showing for the mid-year to be after or the same as your roof year. Okay, so everyone should be that, but every now and then we'll run against an association that has a roof that was replaced, let's say in 2023, but has not provided us an updated wind mitigation report, and it may show 1999 or something crazy there. That's something that, you want to get that to us. You want to follow up, get us that wind mitigation sheet if you don't have it. You do not need to update your wind mitigation sheet every 5 years. Some people think they need to get a new one. The only time you need to get a new one is when you replace your roof, okay? So that's something that's been miscommunicated in prior years, or just misinformation, not that anybody's fault, but that is something there's confusion on. You only need a new wind mit report when you replace the roof. And then on the right, you'll see prior claims. And it's either going to say no, which most of yours will say no, or it might say yes, and then it'll tell you what that claim is. So general liability, directors and officers, and property. Those are the 3 types of claims that can impact the program. If you have property claims or liability claims, you're taking an additional ding on your rate. Remember though, having one claim, let's say someone slipped and fell, a claim was filed and nothing was paid, or only $1,000 was paid, that's not hurting you. The only way you get hurt on this is if the losses that have been incurred on our program is more than 40% of the premium you've paid over the last 5 years for that line of coverage. So we're giving you some room for error there. We're not hurting you just because you had one loss. But we have some associations here that have hundreds of thousands of dollars in slip and fall losses, water losses, whatever the issues might be. So those associations are paying a higher rate than those of you that have no claims. And there's a crazy stat here, but only 9% of the associations here have had liability claims, if you think about that. So less than 10% of the associations are responsible for 100% of the losses. So, those associations, and again, doesn't mean you're a bad association, things can just happen, but those associations that have claims, I think you would all agree, it's fair that they pay more than the associations that don't, all right? So keep that in mind. Now, as you go down below that, you'll see option 1, option 2, and option 3. The only difference between those options is going to be the hurricane deductible percentage. So if you go to the far right and go to option 3, that's the 5% hurricane deductible. That's the highest deductible you can take. And the reason it's set up that way is if we went beyond 5%, all the loans that you have on your units would no longer be valid. They don't allow for more than a 5% deductible. There are associations that have to take that, and then obviously Fannie and Freddie can't close on loans there. It becomes other problems. But 5% is the max for all intents and purposes. So 5% is the same as our option 3 was last year. So if you want the cheapest option and the highest deductible, that's option 3. Now, if you go to option 2, that's where you're going to see some change year over year. So last year, option 2 was a 4% deductible. Now it's a 3%. There's no longer a 4% option. So it's 5%, 3%, and then option 1 is the lowest deductible, which is a 2% deductible. I would encourage, again, everyone here to strongly consider the 2%, or even the 3% if you have to do it, because the rate, we're getting such a good deal in relation to the rate or the cost of that that it makes a lot of sense. You're getting ahead of the money there by being able to do that. So if we kind of walk down one of these things, I'm going to walk down option 2 just to walk through with you guys. That's a 3% deductible now instead of a 4. The limit of insurance on my sheet this is an Andover, is showing 2.2 million. So yours, that's the new value that we're insuring your property for. That's 5% higher than it was last year, remember? So you're insuring 5% more building. The all other perils deductibles remaining the same at 10,000. The hurricane deductible is what's going to differentiate. So this one that I'm looking over, Andover, is 68,000 for option 2. If they chose option 3, it would go all the way up to 114,000. If they chose option 1, it would go down to 45,000. So there's a big difference between those hurricane deductible options. And again, if you keep going down this list, you'll see that the premium differences in this particular one that I'm looking at, they got a new roof in 2024. They chose a 2%, or the option 2 last year, which was the 4% deductible. If they chose option 2 again this year, not only would they be getting a 5% increase in value and the 1% decrease in deductible from 4 to 3, but they would save 12% year over year. So this association might have budgeted for a 10% increase. Now they're seeing a significant decrease and significant improvements in coverage and deductibles. So my recommendation for this association would be, why not go with the 1? They'd still see a 6% decrease year over year and get a much better deductible. And it'll also help for future years, because when we come in and do the renewal next year, my goal will be able to drive a 1% deductible if I could make that happen. That's what we used to have here back in the day. And that'll make it a lot easier to get to that number than if you were dropping from 5 to 1. So some things to think about. All the stuff in the middle, the general liability, crime, directors and officers, umbrella, and work comp, you don't have to worry about that. All of that is identical year over year. We're not changing anything negatively. All that stuff is great. No problems there. So I'll talk a little more about that in a second, but that stuff's good. So really, when you get to the bottom of this option sheet, where it's yellow is where you want to mark with an X. Do you want option 1, option 2, or option 3? You pick that, and then you go to your payment options. You could either decide to pay in full, or you could finance. Again, if you go to the top of the sheet, it shows you what option you picked, and whether you paid in full or whether you financed. If you decide to finance, last year's finance rate was 6.99%. This year, we got that reduced to 6.5%, so it's down half a point. The reason for that, and you guys know because I've mentioned this in prior years, we pass along the bank rate. Our agency is not adding fluff to that to make more money. We're taking whatever the bank will give us and we're passing that rate down to our clients. Because of the size of this program, we're able to negotiate down to a 6.5% rate. If any of your associations were on your own, and you can look at this because I've looked at all of them, any non-participating association that's here with you guys, their interest rate on their finance contracts are north of 10% in some scenarios. Some maybe closer to 9%, but it's a lot higher than 6.5 because you're only insuring like $30,000 in premium. That takes a much higher rate because the premium's lower. We're talking about millions of dollars of premium when we're putting this together, so we're able to get that lower rate. So again, that's a benefit of being in the program. You're probably paying 3 points less in interest than you would outside. Then you'll see the board member printed name. We want you to print your name there for our records. Board member signature underneath that, date and email address. If you put the email address on, we can send you an email copy of what you selected, so you have this digitally if you need it. But this sheet with those selections needs to be in by December 19th. As you'll see on the top of the sheet in red, if you do not decide by December 19th which option you want, we have to decide for you. You will automatically get option 2. That's what we've always done. That is no different than any other year. You're going to get option 2, and you're going to finance it. So the 2 things we made for you, because we can't let this go without, we need to have everybody decide in order to finalize the program. So you'll get option 2. So if you do not hand this back, you're going to get option 2. Make sure you understand that it's going to be financed. If you hand it back, we go with whatever option you pick. Now as we turn over to the second page here, second page I'm going to run through real fast. You'll see this is a little more detail on each of the coverage lines. And so the property insurance at the top, you'll see the 2025 value on this one is $2.28 million against 2024 of $2.17. So you can see right there, that's a 5% difference if you do the math on that. It's showing what we insured you for in 24 versus what we're insuring you for in 25. Okay, so that's an increase of about 5%. That's a good thing, all right? Then the valuation is replacement cost. That's really important because again, if you were on your own as an association and you had a roof that was older than, let's say, 12 years, a lot of the carriers would be valuing your roof covering at actual cash value. They would depreciate your roof. At the time of loss, they would pay you whatever the value of that roof is, not the true replacement cost. Being a part of the Century Village program gives you a huge advantage because we don't have any depreciated value. You get full replacement cost. So if you're sitting out there with a 24-year-old roof, they're going to put on a brand new roof if you have a loss. You would never get that if you were out on your own with a 24-year-old roof. You'd not only be paying a lot more with a much higher deductible, but you would never get replacement cost on a roof at that age. So just kind of some things to think about outside of Citizens. Citizens technically still gives you replacement cost, but they would be very difficult to insure a building with a roof that way. The insurable value change to the 5% we just mentioned. Cause of loss is special form. That's your most inclusive. That's the best form coverage. It goes basic, broad, and special. You get special. Co-insurance, 90%. I mentioned that before. That was 100% last year. So that's improved. The lower the co-insurance, the better. So that gives you that 10% margin of error. The other coverages here are all identical year over year. The fungus, wet rot, dry rot, mold. Our program's giving a $50,000 per occurrence number, which is great. Ordinance or law coverage, the increased cost of construction due to code changes, which is very difficult to get for buildings of this age. You have that coverage. It's limited to 2.5% of the building value. But I will tell you again, if you were on your own trying to get that, you likely wouldn't be able to. Citizens does not offer ordinance and law. They don't give it to you. You can't get it. You can't buy it. So that's another benefit there. Backup of sewer and drains, we have 150,000, it's more limit than we probably need. Wind-driven rain, another $250,000 is given in that. It's just, again, enhancements that the program provides. The hurricane deductible options, which again are per calendar year now, not per building, and you'll see for your building what those are. You already saw that on the last page. The general liability is identical. Our general liability program is a little unique. If you were out on your own, you likely would only get a $1 million general liability program. $1 million, $2 million is what they call it. Our program's a $2 million, $4 million. So it's giving you $2 million per claim with a $4 million annual aggregate. So it's the same as it was last year. It's not changing, but that is an advantage again of the program. Then the crime program is identical. The limit you see there depends on your cluster, because the crime programs are done by cluster, so they're going to change a little depending on who you look at. But that is done based on the financials of the association. That's a requirement per statute. Directors and officers insurance, we moved the D&O last year to a new carrier, not a new carrier, but a new program year over year. Went to the Skinner program because they provided us better terms, pricing, and they removed some exclusions the other carriers were adding. They have now become the hottest program out there. So we're remaining with them. We're one of the only agents that has access to that program, so it's another advantage we're able to bring. Because everybody here has their own D&O program. That is not something we share. So the only things we share are property, general liability, umbrella, and legal defense. The crime to some extent. But the D&O is the only thing you're really buying by yourself, and the workers' comp coverage we'll talk about in a second. And so that's important that that's done as best possible. So you'll see some D&O deductible differences. If you have claims, your deductible might be slightly higher, but everybody else's will stay the same year over year. Workers' compensation, same as it's been. Not going to go into that too much depth, but that's there for any potential uninsured vendor that gets injured on your property, brings a work comp suit. You have that protection. And then the legal gap defense coverage, what I mentioned earlier as well. That's new this year. Provides the unlimited legal defense and the hours, the legal defense hours of free legal advice. And at the bottom of the sheet, this is important, there's a note here that says, please be advised that this is a coverage summary, that stuff on here may change. I have to say that every year, because your renewal is not until January 1st, and we won't know until December 19th how many of you are going to be in the program and what options you're going to take. So some of this stuff may still change. Like for example, we still have an umbrella quote out there that might be better than this umbrella quote. If we get that in, we're going to swap that out and it's going to drive savings to everybody. So there's some improvements that may come, but I feel confident in telling you that this stuff may change, but it's not going to change negatively. I mean, is it possible? Yes. But in the 4 years of me doing this, we've always come in and been able to at least improve upon this. Nothing's gotten negative from here. So the goal would be to keep this the same or better, but there could be things that change. But again, anything that changes should be an improvement that we would swap out, not anything that's going to make it worse. All right, so I know I just said a ton of stuff. I don't know how long I've been going there. Oh, goodness. So let me turn it over to you guys. We have Jill on the mic. All right, you want to run around? Anybody have any questions for me? Let's open that up and we'll go through it. So I'm going to have Jillian bring the mic so you can talk into the mic. I think that will be easier for you guys. You want to just start in the back and we'll work it back up here.
Hi, our building is on schedule to have the electrical panel upgraded beginning in February, as well as all the structural repairs and painting done by June. Will that decrease our premium for next year?
Okay, so great question. So the electrical system is going to be upgraded there, and they're going to do the structural work they need to do. That will not have an impact on the premium directly. There's no rating basis to give you a rate decrease or increase based on that, but it helps collectively everybody, because there could be a time, and I can't guarantee this might happen next year, where the carrier says, we will no longer insure buildings that can't prove they've had the updated electrical system. You guys would be able to show that and you would be fine. So you want to do that, but there's no direct impact to the premium for doing it. So just make sure I said that.
So in essence, the roof is the big improvement that makes a big difference.
I'm sorry?
So in essence, it's the roof that really makes a difference.
Yeah, so remember guys, you just want to be able to hear all this stuff, especially for the recording. So we try to be as quiet as we can on it. The roof is the only thing that has a direct relation to the rate that you pay. That and the losses that occur in the association. We can't put a rating metric yet for the electrical. That doesn't mean that won't happen. It just depends on what the market does. If the carrier comes to us and says, we can no longer insure buildings that don't have it, we're tracking all this stuff for you. So we know that there's 110, whatever the number is, that have not upgraded that panel. Those associations, if they were going to stay in the program, may end up getting a rate increase because of it. It's not the way the current program is set up, but that may happen in the future. So you want to get on the right side of that. So it's good that you did it, it's just not a direct impact into the program yet. Okay, all right, so we got more. You want to just work your way up here, Joe? All right, we'll get to everybody, I promise.
Hi, I have two questions. So it's one is here. Our roof is 20 years old, and this will cover 2026. To get the extension
How would that affect
COA.
our premium? Generation?
Okay, so if your roof is going to be 20 years old in 26, that means it was replaced in 2006. So if you're a 2006 roof, right now, you're in between 15 years old and 20 years old. So right now, you're getting hit with an additional rate because of that. Once the roof gets to 20 years, you're going to get into a little more rate that you're going to have to pay. So the older the roof gets, once you're at 20 years and beyond, you're going to end up paying an additional rate because of the roof.
Right, but it doesn't become 20 years old till the middle of 2026, so they give us the premium for 2026.
No, so right now, 2025 is what we're looking at. So next year, we do the renewal for 26, that's when you'll see that impact. So even if it's the middle of 26, it doesn't matter because you look at when the storms are going to hit, it's going to happen in June to November. That's hurricane season. So the carrier is really looking at the roofs that turn that age in that year. We have some flexibility if it's like a January. Yeah, so we have some flexibility, but not that way. So if your roof is going to be 20 years old and 26, that's when it hits. It doesn't matter when the roof was exactly replaced.
And how much increase should we project roughly?
So that changes every year. If you email me, I could look at the numbers and tell you exactly what it is. I'd be guessing if I said right now, but we try to make that impactful. I mean, like it's not nothing. It's 20%. You know, it could be significant because there's got to be a ding there because those roofs are what's keeping everybody from potentially getting even better rates. So there is a ding. You have to email me. I can give you the exact number.
Okay, my name is Joanne.
Sure.
I'll email you. Thank you.
You're welcome. Right here.
No, but in some cases, children own the union.
Hi, good morning. I have about 4 questions. First of all, about the electricity. Well, the electricity, I don't know if many people know, but 15 years or more, Yoko had a program that would change all the electric boxes from the aluminum tempered to copper. Is that what you're talking about, the new thing? Because we did go it out of the code about 15 years ago.
So there's two things going on there. So there's the electrical panel that's outside the building. That needs to be upgraded, that's on its own. And then you have the wiring within the building. Any buildings that have aluminum wiring, not copper, what we would recommend is that you have the buildings or the, what we call pigtail, it's like a short thing, put the copper little connection to the end. Because if you worry about aluminum wiring, just for people who don't know here, aluminum wiring will expand and contract at basically the outlet. The actual aluminum wiring in the building is not the problem, it's the outlet, because it shrinks and expands, and it can cause a spark, and then a fire could occur because of it. Because of this, the carriers don't want buildings that have aluminum wiring that haven't been protected. And so you protect it by doing the what we call the pigtailing. So if you've already done that, or you've already updated the electrical panel, that's a good thing, and you're in a good place. But I know there's many associations here that have not done either, and that's a problem.
Okay. Second, the question is the private homeowners insurance have coverage for the deductible. That is $2,000 today. Is there any way we can increase or take care of this higher deductible of the association?
Yeah, so what he's mentioning there is everybody who has a homeowner's policy here through a state of Florida company is getting an automatic $2,000 of something called loss assessment coverage. So what that means is if you have 24 units in your building and you get hit with a hurricane, those 24 units, if you pass an assessment to those owners, you could pass a $2,000 per door assessment, so $48,000, and those homeowners would not have to pay that assessment. That assessment would come from their homeowner's insurance carrier to help pay for your insurance deductible. Because of that, that's why we recommend going with those lower deductibles, because if I look at my situation here, this is a perfect example. This is Andover. They have 26 units in this building. If they go with the 2% deductible, that means their hurricane deductible will be $45,000. If they pass an assessment for $2,000 a door on 26 units, that's over $50,000. That pays for that 2% deductible without actually coming out of pocket of the owners. So we would recommend everybody that lives in a unit buys homeowners coverage. You need that because obviously our policy is stopping at the drywall. So your interior build out of the unit is on your homeowners policy. Plus that homeowners policy will pay you up to $2,000 in loss assessment coverage. So it's strongly recommended for your owners to have that. And if you're in a situation where you can go to the 2% deductible, you likely can pay for your deductible through that loss assessment coverage, which mutes the cost to the owners.
Yeah, the next question is what many years ago, American Coastal didn't do the whole, or they couldn't insure the whole village because of exposure, that they had too much for 33417. Now I see that we have a cluster of 20 units. Is that just the 20 units or is it a part of the whole village? Because you're talking about the whole village. Our policy only insured 20 buildings, which is two sections. Cambridge and Canterbury. So
Yeah.
what's behind it?
No, so American Coastal is still insuring everything. They're just doing it in chunks. And when they do it in chunks, it's actually better for you because every one of those policies is giving us additional sublimits of coverage. So instead of having one policy over everything that would reduce the, like, for example, the wind-driven rain or the water backup or whatever that is, you would just have that limit for the entire complex. Instead, you're getting it for that cluster. So it's a way of providing better coverage. It's still negotiated as if it's one program. So American Coastal is still rating it as it's one program, but we break it up to deliver more coverage basically.
Okay, so on this point here, we have coverage. I mean, we had deductible of $10,000 and we had water damage, bacteria, mold, whatever. How much is each building? 10,000. In this case, we don't have coverage.
Why?
If the deductible is 10,000 and the normal bacteria, which we have here, if a pipe or water heater has damage, it doesn't come up to 10,000, it comes to 7, 8, or 4.
Well, yes, of course. If you have a loss that's under the deductible, there's not going to be coverage. There's nothing, I mean, that's
So how much is the coverage for 2025 for each building for mold?
No, so-
10,000 still?
No. You should talk about two different things. The deductible outside of hurricanes, so anything that's not hurricane related, is a $10,000 deductible.
Yes.
The mold coverage is a $50,000 coverage supplement. So it's $50,000 in coverage, but it's a $10,000 deductible. So anytime you have a loss at one of your buildings that comes up to $7 grand or $8 grand, remember when you have a loss, It's the cost of remediating the water. That's usually split between the unit owner and the association. And if you think about that, if this is my association and this is the wall of my unit, the owner is responsible for this wood paneling. They're responsible for the wall covering, but the association is responsible for the drywall, the unfinished wall behind it. As you know, if you paint this wall, you can't dry out the paint, but not dry out the drywall, right? So industry average is usually to split the cost 50-50 for the remediation. So what I would encourage you to do is if you have a loss at one of your units, like a pipe breaks or a feed line to the toilet, and it goes from one unit to the other unit, when you get the restoration company out there to do the work, you want to make sure they split the costs up. So the top unit is, let's say, $2,000. The bottom unit's $4,000. The association will be responsible for half that, essentially, so 50% of that dry out bill. Any drywall you need to replace or repair would be on the association. But the cost of painting, texturing, and everything else for that drywall would be the unit owner's insurance policy. So if you have a situation that the association costs are under 10 grand, which is going to happen in most of your small water losses, it's not going to make sense to file that claim. It's going to be under the deductible. You're just going to deal with that. Now, if it's a fire and or a massive water loss, or if lightning strikes or different scenarios that occur, then you're going to be well over the 10 grand, and that's when you're going to file a claim. And that's kind of how it works.
Yeah, well, my last question is on the deductibles. Okay, now, on the cluster, we have 20 buildings. Okay, the liability is 4 million for the deductible. Is in a case of catastrophe or just a lot of damages, is 4 million and enough? That's the question. Is it for the 20 or for the whole village, or just for the cluster, the 4 million that we have coverage? For 20 buildings, if you divide it, if catastrophes, it might not be enough.
Yeah, I think that's confusion. You have 100% coverage. So the total values that we have insured, you don't see that on the sheet, so I apologize. But we have if you look at the total value we're insuring here at Century Village, and Jerica confirmed this, but it's like $730 million. Yeah, I know, but $730 million in property coverage, and that is not sublimited per section.
Liability.
Yeah, okay, so on the liability side, it's $2 million, and then the umbrella is
4
$4 million.
million, 20 buildings.
$6 million total. So you have a $2 million underlying, you have $4 million excess, so it's $6 million total. That's total for everything. But the premium or the value of the property that we're talking about, that is the $700+ million. There's no sublimit to that. So if this place got completely wiped off the map, I'm not saying it's ever going to happen, but let's say every building here was down to its foundation, we are insuring 100% replacement cost. So there's no sublimit of coverage. Every building would get built back. There's no where we're only buying 100 million of coverage. And that's the thing that a lot of associations that are as big as this have had to do. They've had to buy something called a loss limit of coverage. We're not doing that. I just want to make sure that was clear, because I know you didn't ask that, but that is something that has come up and people get worried about. All right, so you're fully covered.
The liability again, you talked about property, I'm talking about the
Yes, the
liability.
liability, it's not per cluster, it's for the whole property. So you've got the 2 million plus the 4 million umbrella, but that's for everybody. Now it's per incident.
For the 20 building or for the whole village?
For the whole village.
4 million for the whole village?
6 million. So again, 6 million for the underlying, 4 million for the excess. So yes, so you've got that for the property.
Might be a little bit, okay, thank you.
Well, I mean, again, we've got 12 years of loss data here, so we're working off of the loss information that we have. We've never, could it happen? Yeah, of course. You could always run into a scenario, and that's why you have the legal defense and other stuff. But we've never had a loss year here even approach several hundred grand, let alone 2 million, 6 million, or anything like that. Yes, sir.
Under a prior claim, what's a D&O?
Okay, so directors and officers. So if you see prior claim on the top right and it says direct D&O, that means directors and officers coverage. That means you had a directors and officers claim in the last 5 years. And so that would be where the association is brought suit against for things like a collections issue or an ARB issue or whatever it might have been. Somebody came against your association for monetary damage. So if someone slips and falls and gets physically hurt, or their property gets damaged by something they feel like you're responsible for, that's the general liability policy. That covers for property damage and bodily injury. If someone sues for monetary loss due to I always use this example, it doesn't work here, but let's say the architectural committee lets somebody paint their building pink with purple polka dots. and it lowered the value of everybody else's home. That is something where collectively you could see a lawsuit come in and say, because of the decision you made, my home value has now gone down by X, and so they bring a suit. Those are directors and officers claims. So you must have had one, and if you want us to check, Christy's back there, she can run it for you. But that would have meant you had a D&O claim that came in that you have had in the past, so it's impacting the D&O program. It doesn't impact any other line of coverage, just the D&O.
Okay, does that mean it was paid?
Well, it doesn't, so if you have a loss that's showing there, that means you've had a claim. That doesn't mean that that claim is settled yet. I mean, there could be like a reserve that's open, or it may be just going through the process. So we've got some associations here that are paid $100,000 plus in D&O related losses. We have others that have claims open that are reserved for 10 grand, 20 grand, but nothing's paid yet. And then we have others that have no reserve because you're just waiting for the kind of legal process to play out.
Does that mean it's against assured partners, or could it be from prior to assured?
No, well, it's going to be over the last 5 years. So Assured Partners has been here the last 3 years. So if it was before that, it could be prior to us. But the claim's not against us, it's against your specific association. It's just rating the claims off the last 5 years of directors and officers related losses.
That still affects us?
But yeah, so what I would tell you is if you want to know, if you give the name of your association to Christy, she can pull up the exact claim that you're dealing with, and so that'll give you more information. Yep, I got some questions over here.
I only have 2 questions. Most of the units here are 3 buildings. Are they considered buildings, or oh, 3 is 1 building?
So if you have a community that has 3 separate buildings within your association, then they're all individual buildings, but it's one association. So this policy is going to be for the entire association. So some buildings here are just one unit, one building, that's it. There's no separate buildings. Others, like Golf's Edge, whatever, has got 20 buildings, you know? So this sheet is going to be for every building combined. So if you have 3 in your association, it's for all 3.
So it's 1 deductible.
No, I'm sorry. So the deductible is still going to apply per building. So if you have, and I'm just making something up here, but if you have 3 buildings and you have $38 million in value, and each building's identical, that would mean each building's insured for, what would that be, $13 million basically? Or I'm sorry, So you had, I'm sorry, I'm using the wrong figure. So if you had, I'm using the wrong thing, so it was 2.2 million on this one in value. Let's say you had 2 buildings that they're making that up. Each building's insured for 1.1 million, okay, to get to the total 2.2. The deductibles apply per building. So that we 3%, if you took the 3% deductible, multiplied by 1.1 million for that building, and 3% times the 1.1 for the other building. So if only 1 building was damaged, your deductible would be less because it would only be by that 1 building that you had. So it's kind of by roof if you look at it that way.
Okay, so actually, if the total destruction, you're talking 3 buildings.
Well, yes, and that's why that's the way I presented it here. My assumption is if a hurricane hits this property, you're likely going to get damage to every roof. I mean, it's going to be rare you're only going to have a hurricane category 3 hits and only one of your roofs is damaged. Now that can happen, like a big tree falls through one building and the other 2 are fine. And if that happens, our deductible applies per building. So your deductible will be less than we're showing here. So it'll be a third of that basically. So, all right, so just make sure you guys understand that. It's a good question. The deductible we're showing is assuming every building in your specific association was damaged. If for some reason only one of the buildings was damaged, that deductible will be a lot lower.
Second question is, I assume that the price you now have to pay us doesn't include the interest charge.
Correct. So the premium you see at the bottom, because remember, a lot of people don't finance. So we're showing the total premium. If you choose to finance it, then the interest gets added on. So you we have a 12 equal installment. So you take away 1/12, that's basically the down payment, and then 11 installments of the same amount. They charge a finance rate of 6.5% to the balance, and that's over the course of payments. So if you need that number, we can provide that to you as well. But anybody who's financing, obviously there's a finance charge you have to add to that number. It's not terribly significant, but it's obviously something. And so we're showing it without that finance charge. Sure. Another one over here. Okay.
recently, we've been having some trouble with investigations and that kind of stuff. We received a notification from our property management, and I'll quote what was said, and I'm just perplexed, and I'd like some clarification. CV associations that elect to perform applicant screenings using other providers risk being deemed outside of their insurance coverage. Can you please clarify that for me?
Can you say that again? I apologize.
I'll let you read it.
Yeah, I mean, it didn't make sense the first time I heard it.
I do either, so I kind of want to know what that means.
So, okay, this is not anything related to the insurance program.
Oh, it's not.
No, so this has to do with UCO. So they're saying this is about like tenant screening or owner screenings.
Correct, but they're saying that it might, it would be, we risk being deemed outside of our insurance coverage.
Yeah, okay, so what that's saying is that, and I'm trying to think of a good way to say it. So like what UCO is basically saying is if you're going to require, like let's say you had owners that wanted to buy, and you want to answer this one or you? Okay.
Let me do the question real quick. I was in interest. Okay, so here's the question.
How that would affect our insurance.
Please note that the words above, colored red, you go CV associations that elect to perform applicant screenings using other providers risk being deemed outside of their insurance coverage. Okay.
So I'm asking our insurance or how that would affect our insurance.
Okay, so let's do a scenario. If you adhere to your contract, have your tenants and new owners do their screening through UCO. You see something on the screening report you don't like, or you have a question about it. We provide an attorney.
That's not the question.
I will answer the question the way I want to answer the question, not the way you want me to answer the question.
Well, I just want to hear your answer.
Well, have a seat. I'll be happy to answer you, all right? And in detail. So, let's say you have a question. You don't like the way that the screening report looks. You send it to us. We send it out to UCO's attorney, and you get an opinion, a narrowly defined opinion. Do you have discretion to reject? Do you not have discretion to reject? Or you may want to ask for escrow or a cosigner or something of that. But the lawyer says that, not us.
Right.
Now, if you follow our lawyer's advice, get your screening reports through UCO, and you get sued, we cover your deductible, which is mostly $5,000, right?
It ranges a bit. I think it's $1,000 the minimum, it goes as high as $5,000.
Right, so we cover you. So it's an additional unofficial insurance policy. So that's basically what's going on here. As far as you guys doing what you need to do and making a business decision beyond what we provide, that would be a Phil question.
I can answer that, sure. So,
Is that coverage
yeah.
provided through assured partners?
No, that's through UCO. So what he's saying is, and it was good that Donald helped me there because I didn't understand exactly what he was saying. So if
What insurance?
yeah, so our insurance is not covering you. So you're covered under our insurance program, but there's a deductible for our insurance program. What Donald's saying is that if you go with UCO's advice and you still get sued because of it, UCO will cover your deductible. But our insurance policy still covers you. It's just you're paying a deductible with that policy. They're covering that deductible if you go with them. If you don't go with them, then you're on your own for the deductible. Does that make sense? Okay, so yeah, so again, the whole point of that is whenever you're doing, like you're gonna reject somebody as a buyer or reject somebody as a tenant, there's a lot of crazy fair housing laws and stuff. I go through this as a board member and you're always trying to like play that line. I have some boards that are very aggressive. They're like, you know what, this person's they're looking at their collection history, their the credit scores, and they're denying people based on that. I got people denied based on age, based on background. A lot of that stuff's illegal, right? You can't reject somebody because of the ethnicity of the person or something like that. So some boards get very aggressive and they end up in these lawsuits. And so what Donald and UCO are saying is that we're doing the work behind it. If you go on our advice, which is going to be legally backed by the attorney, and you still end up getting sued, we'll cover your deductible instead of you guys having to foot that. And so I just learned that today. Again, it's outside of my world. I'm insuring you through the insurance policy, but as far as what pays your deductible, that's what UCO's saying they would do if you were listening to them first.
10 years, we have done 3 checks.
Okay, perfect. So that's good news. Yeah, so in 10 years, they've only had 3 that have popped up that have been a problem. Okay. Yeah, sure. Yes, sir.
Just have a question, really, one of the questions that was asked before. We live in Oxford 200. There are other Oxford, like this Oxford 400. These are 49-unit structures built around a courtyard. They are basically joined, there's 4 buildings. They are basically joined through breezeways. There is a walkway that goes completely around the building. Are these 4 structures, or are they individual buildings, or it's part of the one?
Do they share a roof line?
Yeah, the roof goes all around.
So usually the insurance carriers will consider it the same building if they share a roof line. So if they're sharing a common roof and there's no clear delineation between the buildings, it's usually considered one building. What I would tell you is at time of loss, we always try to look at that in the most optimistic or best way for you guys, where we would try to look at it on a per building basis. But if one of your buildings, if you consider a building was damaged and none of the others were, it's probably unlikely, because if we get hit with a hurricane, it's likely impacting all the buildings anyway. But for argument's sake, I would tell you that if it's got a shared roof line, it's likely going to be considered as one building. That's how the carriers typically do it. Now, if you have the proper rating of firewalls or distance between the buildings, we can sometimes get wiggle room there. But again, it would only matter if a hurricane hit you and only one section was damaged. That's the only way that's even going to become something that would be an issue.
It could be like a tree falling. There's some pretty big trees in the courtyard.
And if that happened, I give you my word, we would, in those scenarios, we absolutely would look at that as beneficial as possible to you. It doesn't mean the carrier is going to agree, but the way we would put that claim in would be as one building. We would try to make it as favorable as we could. I would tell you it's very unlikely, because again, it would only be in the case of a hurricane, but if that did occur, we would try to look at that as favorably as possible.
Okay, thanks.
Sure. You got one behind you, Joe. Oh, you're there too.
My question is that all things being equal, the only difference is the hurricane insurance.
Yes, sir.
And you have to opt for choices based on what your deductible is.
Yeah.
But in my case, you have a deductible at 3% of $44,000 versus at 5% $73,000. So one would have to endure the minimum, in this case, let's say for 3 at $44,000 before you pay out $1. In that case, what is one's vulnerability in terms of that kind of exposure that one would incur the likelihood of exceeding that amount? That why not opt for the higher amount, given the fact that you'll never meet the deductible in most cases, given the history or the debt that one could potentially incur?
Well, I would tell you that, yeah, odds are in any one year, no one here is going to file a hurricane deductible, because we have to get hit with a hurricane for that to happen, and that's not an every year scenario. But if you look at Wilma, which came through here, and you look at the amount of claims that were filed at Century Village, was significant. Even during Irma, which before I got here, there were at least 30 or 40 new roofs put on from that storm, or whatever those numbers were. It was multi-million-dollar loss. So, yes, you have to get hit with the hurricane for that to happen, but I would caution anybody here that looks at a $40,000 deductible and says, we're never going to have a $40,000 loss no matter what, so I'm going to go with the higher deductible. Because when a hurricane hits, like Dorian or whatever comes through, the damage is not just putting on a new roof. Everybody thinks that, hey, I've bid my roof before. My roof cost $30 grand to replace, and I've got a $40,000 deductible, so I'm never going to achieve that loss. I've been doing this for 20 years. I've had thousands of hurricane claims. That's never the way it happens. Because when a hurricane takes your roof and damages it here, the cost of the roofs within Century Village do not stay static. They increase substantially because the amount of demand for materials, for labor, the costs go up. So there's one issue. The second thing is, it's never just a roof that's damaged. You've got water intrusion coming in, you've got dry out remediation, drywall, you've got, it sometimes gets into the electrical, you've got soffits on the roof, fascia, exterior part of the building, like paint that gets peeled back from the wind or whatever that might be. You could have windows that are dislodged or broken. So the cost of replacing it can far exceed what that deductible is. And so sometimes when nothing's happening, you look at it and say, 44 grand at 3%, I'll never get there, I might as well go to 64 grand. And there's some boards that look at it that way. And in a market where the rates are very high and you're going to see a savings, I get that. But in this market where we're getting such a rate decrease to go with the 2% or to go with the 3%, you're getting a discount for it. If it's me, I would take the lowest deductible I could take, assuming it wasn't hurting my budget, because we don't know when the hurricane's gonna hit. I mean, you look at Hurricane Andrew, that hit late in the season, first storm of the year, and really the only major hurricane of the year, but it hit smack into Kendall. So if, you're gambling in any year that you go with the higher deductible. I get why some people may do that here. They've got that money they need to spend on a new roof. They've got other things they need to do with it, and everyone's here gets to make that decision as a board member. But I would caution anybody here to take a higher deductible because they don't think they're going to hit their lower deductible. These losses will be significant post a major storm, and then you're going to be stuck having to pass assessments that are beyond what that loss assessment achieved back is. So hopefully that helped, but again, yes.
I just wanted to triple check.
Sure.
I do understand that if the associations do not submit our documentation by the 19th, you will select option 2, 3% for those who do not select, correct?
Yes, it'll be option 2, it'll be the 3% deductible, and it'll be financed. Those are the two things we select for you.
Correct. But you are suggesting that for most of us, because of everything that you configured, that you are suggesting we select option 1 at 2% because it's the lower deductible?
Well, okay, so I just want to make sure I'm clear. You guys can do whatever you want, so I'm not trying to push you into any one option. My recommendation, though, because I know behind the scenes the benefit and the rate that we're getting, we got a very positive deal to get it to 2%. If you were a standalone association, and I can tell you this because I review those standalone associations, the ones that do not participate in this program. If you don't participate in this program, go out and try to buy your deductible from 5% to 2% and see what that cost ends up being. First, what we're showing here. You're getting a far better rate for it. So in my opinion, if you want your best bang for your buck, it's the lower deductible. You're getting your best premium with the least exposure, right? If you go with the 5% though, it's completely your board's decision. I'm not knocking boards that do that. There are reasons to make that decision. You may look at it like, I've got plenty of money in reserves, I've got a new roof, I'm going to go ahead and gamble on there not being a storm and go with the higher deductible and take the savings. Or financially, it may not be affordable for you guys to take the 5%. I get that, or take the 2%. But if you have the ability to do it, if it's within your budget, my recommendation would be to strongly consider options 1 and 2 versus option 3. It's going to give you more protection, and then in future years, when we get even lower deductibles, the difference between those will be better and easier for you to achieve. All right, got one here.
On the electrical, you're not talking about the panels in the unit that's 30, 40 years old.
Correct, we're talking about the main panel for the building.
Main panel that's feeding the building.
Yeah, because the panels in the units are likely the unit owner's responsibility to maintain and replace. So I like my Brooklyn guys, good question, that's good stuff. So yeah, so that's, again, it's for the exterior main panel, not for the individual panels. Now granted, owners in those units may want to update their original interior panels because those are out to date too, but that's a unit owner issue, not ours. Yes, sir.
Yeah, 2 more questions now. On the 2025 policies, do we have non-subrogation, the association versus the unit owner? That's one thing. Second, a problem that we have in the village, which is quite common, the damage starts upstairs and the big problem is downstairs because of the leaks. Now, usually what happens is that although the upstairs supposedly didn't change it on time or the toilet broke up, the downstairs take all the damage. Is there any way that everybody keeps coming and asking, can we sue the upstairs? That's one thing. Second, okay, I'll ask the question.
Okay, so what you're asking is if water damage occurs to the first floor, can you go sue the second floor? So this is a more complicated answer, but I'm going to give you, it's not really my answer to give, but I'm going to go ahead and give you the attorney answer, if you will. So if a unit owner upstairs has a pipe break and it goes down to the first floor, usually the floor under it's what takes the most damage. The pipe bursting is not necessarily anybody's fault, okay? So in the event of a pipe burst, that is no different than a tornado ripping the roof off or a hurricane ripping the roof off and water coming in. If that occurred, each unit owner would be responsible for their portion of the damage, and then the association is responsible for their portion of the damage in both those units. That's how that works per the statute. The statute gives the association flexibility in the event that the upstairs owner is either negligent for the damage, or fails to follow rules and regulations, or commits the damage on purpose. If they do one of those three things, the association can assess the upstairs owner for the cost of damage that the association had to pay that's not covered by insurance. So I'll give you an example. If there's a loss upstairs and you have a guy or girl, whatever, we've seen this before actually here, we've had scenarios like this, but somebody does something incredibly stupid and negligent. So we had somebody trying to flush their sheets down the toilet. Do not flush your sheets down the toilet. You'd think that'd be something that I don't have to say. But if you did that and it caused water to back up and go downstairs, the association ends up costing them, let's just say $8,000 in dry out. You can bill that upstairs owner $8,000 and attach it to their ledger and lien the unit over that. Again, you want to talk to your attorney about this. I'm not an attorney, but that would be the way to go. The statute gives you that flexibility. Now, if you had a $20,000 loss because of that, and our policy paid $10,000, but you had a $10,000 deductible, you could only pass the cost on that you incur. So that'd be up to the $10,000 deductible. So you can't bill them for $20,000 and get money from insurance and them. That's the only.
So I'm coming to the original question. Is the clause of non-subrogation unit owner versus association? Non-subrogation.
So the association's carrier, so we don't have the ability of subrogating. Where you're really going to run into that is going to be the unit owner, homeowner's carrier, trying to subrogate the loss against the association, which technically by statute they're not supposed to do anymore, although we do see people try to do that from time to time. But your association, and I guess I'm trying to figure out can you give me the example you're talking about where this is going to happen?
Non-subrogation, because if it does something stupid, the association can come up, or his insurance, or vice versa, can come up against each other. We used to have non-subrogation on this.
So we don't have, because we're trying to participate in the statute, the property policy does not have the ability to subrogate. That's what you want, because it'll help you in the event of the homeowner's claims. So it's set up the way it's supposed to be set up. But it doesn't stop the association from coming after that owner for the part that the association is responsible for if one of those three things I said happens. They did it on purpose, or they did it negligently.
Gross negligence, yes. And the last question then is, what about, you talk about replacement. What about law and ordinance?
It's in there too. So you'll see that on page 2, under that's 7 bullets down. Ordinance law, we have full coverage A. We have a 2.5% per building limit for B and C. And C is the increased cost of construction, B is the demolition cost of the undamaged portion, and coverage A is the undamaged portion of the building. You're welcome. Got one over here too. Yes, go ahead.
I can talk.
Yeah, small enough room now.
I'm looking at last year's quote, and I'm noticing that although we have in our general liability, last year it was 1 million per occurrence, 2 million general. This has increased. However, I'm also noticing that our umbrella went from 10 million to 4, and our workers' comp went also from 115 to 151.
Yeah, so what happens there, and this is why that last sentence is so important that I mentioned, is that when we're presenting this, we're doing it a month before renewal, so we're showing what we believe it will be. The umbrellas are the toughest because you need to finalize a general liability option before you can finalize the umbrella option. And so last year you had Philadelphia, which was the carrier here for a very long time on the general liability. They non-renewed this account. It wasn't your fault. They made money off the account, but they got off of all the Century Village communities. I mentioned this last year during the presentation. So when they non-renewed, we had to replace that coverage. But marketing an account like this and having the exact terms 30 days before is extremely, extremely difficult. So last year was a very tough year. We had to replace the general liability, and then we needed to replace the umbrella. So we had no idea what the umbrella terms were going to be until weeks after we ended up doing the presentation. And so the general liability, we ended up being able to get a 2 million versus the 1 million. So that doubled, but the umbrella came down from 10 to 4. Now this year, and I mentioned it earlier, we actually, is Jenica still in here? No, she's out there. Okay, so we have the ability this year with the umbrella, and it's okay, I don't need her for it, was to potentially get that back to 10 million. We won't know for another week or so, but that's kind of how this goes. I wish everything I showed you here was exactly what it was gonna end up being, but it's impossible because.
Considerable lowering of the amount.
Yeah, so basically we went from 10 and 1, which was 11, to 2 and 4, which is 6. But again, if you look historically, so we got 12 years of claims data. I mean, it's very extreme. We've never had anything above $1 million. So it's, you know, it's not as bad as it sounds. But again, you're collectively trying to ensure a risk while keeping in mind cost of coverage and things like that too. But I will tell you, this may end up being more than 4 this year. And if you can obviously email us, let us know. This will be finalized, and it may get to 10 again. So that is very possible. But the insurance market overall, especially the liability market, that's tightened considerably. So we're always trying to balance what the costs are and what we're getting versus what the risks are. So last year, the cost of the 10 million umbrella was like, I mean, it quadrupled the cost of the umbrella. And you guys were already taking big increases on the property insurance and other stuff. So we're always trying to like make sure we're not buying more than we need that's going to be costly. So again, it's part of our process, but we've gotten through this year, you know, barring the next few months, and our total loss ratio on this account on the general liability is like 1.8%. I mean, so we don't have claims that are even coming close to a few $100 grand, let alone anywhere near the deal. So we're doing very well. And Christy, who was in here too, will tell you, we stay on top of that. Not only is UCO doing a good job from the whatever they can do to help maintain some of these items, to prevent some of these issues, but our claim intake process is significantly better. So we had our loss control people do building walks of all of these buildings. Buildings have made improvements to trip and fall hazards and other issues. Plus our what we've done on our claim intake, when a claim is filed, we make sure it's actually the association versus it being UCO. Or remember Century Village, Centerville, which is also WPRF, they have pieces of this too in the rec facilities. So before we came on 4 years ago, I found tons of claims when we did our analysis that belonged to UCO or to WPRF, hitting you guys at your associations, and vice versa, where you guys were the claims. So we came in and that was one of the big missions, was making sure the claims go to the right place. And so I can promise you now, since we've been here, that has absolutely not occurred. So we've made sure that that's been cleaned up. And now when a loss happens, it all depends on where it is, who's responsible for that property, and in the gray areas, we get really into the nitty gritty on it. So we've cleaned that up significantly. And if you see the loss history on the Century Village master that we're talking about today, it's gotten significantly better. And a lot of that is the work that you guys are doing, but it's also the claim intake form, having Christy here and doing all that stuff. So it's been a big success story. So again, it may sound like that stuff decreased a little, but that's only year by year. It may absolutely go up this year and so forth. Any other questions? Yes, ma'am.
So we're fairly new to this whole programming stuff, and I don't know what it means by the umbrella. What exactly is that? I know overall, but...
So it's going to be, so the umbrella is liability cost. So it's going to be bodily injury or property damage that suffers to a third party that then brings suit against the association. So this is an example. The most common is slip and fall. So you have somebody that's in your association that falls down the stairs. Let's say the stair breaks and they fall down and break a hip, break a neck, whatever it might be. That's a liability claim. Or they slip in a slippery substance outside. Those are the most common claims we see, especially at Century Village, is you have a unit owner that's injured after a fall. They're, Morgan & Morgan, you guys have heard the ads, right? The plaintiff attorneys, they go to them and then they come after your association for liability damages. If that happens, you have the $2 million underlying general liability and the $4 million excess. And we just talked about that $4 million, maybe more, going into this next year, but we still have to work that out. But that's there to protect you in the event that lawsuit occurs.
And am I seeing this right? Last year it was $10 million on the umbrella with zero deductible?
No, it was $4 million. It was the same. That didn't change year over year. It's just the option sheet that we presented last year showed 10 because we didn't know what it would be yet. And in my last year presentation, I went into depth in that. I was like, listen, this is our expectation. This quote is still not there yet. So we recorded all that and everything too because I couldn't guarantee what it would be. This year, I can guarantee it won't be less than 4. It might be more, but it can't go down. So we already have the umbrella quote this year. Last year, we were moving the general liability carrier and the umbrella carrier, so it was chaos right about now. You just had to project. It was a guess. Whereas now, we have both of those quotes in. So what you see here will not be worse. It might get better, but it won't be worse. And so what I said earlier about the premiums, that's where it got better. Yes, sir? No, so every building's gonna have one of those electrical panels outside. It's just many of them have already been updated and replaced over the years, but there are some here that are still the originals that have not been updated. Those are the ones we wanna focus on. Any community that does it and looks and has the original Federal Pacific or whatever put in 1968 or 74, those are the panels you wanna update. Yes, ma'am.
So on that panel, like, we have 3 buildings. The main building has a big electrical thing in the back room there. Are you talking about each building has an individual panel?
It depends how your buildings are configured. So the association I'm on the board for, all 20 buildings have their own electrical panels outside the building, and so we have to replace 20 of them. If you have a 3-building system where for some reason all the electrical runs into one of the buildings and the other 2 don't have a panel, then you would only need to replace the 1. If all 3 buildings have an electrical panel, then you would need to replace each of the 3. So it just depends how your buildings are set up. And again, you want to talk to an electrical engineer or an electrician that specializes in that. I can't, I'm not that, but I just know that from an insurance perspective, it's an issue. And then from a resale perspective, because anybody that's a 3-story building here is going to have to go through that phase 1 structural inspection, and part of that is electrical, and that stuff's going to come up there too. So keep that in mind if you're a 3-story. Yeah, most of you are too. Any other questions? This room's gotten pretty thin here, so we're down to the last few. Yes, sir.
In what way is your association responsible for water leak due to hot water heater in someone's apartment? I assume there's an obligation to remedy in terms of cost to the homeowner below. But is the association going to be responsible or can be subject to a loss?
Okay, so a hot water heater loss was the question. What happens? So hot water heaters do burst from time to time. They go bad, you have damage underneath it. What my strong recommendation would be to everyone here and to every board I ever meet with is you can adopt rules and regulations, which is something you can do in a board meeting, that says every owner here cannot have a hot water heater that's older than 15 years old. Like, you can make certain rules like that. And you can make it so that the feed lines to the toilets have to be braided stainless steel, not plastic. These are things you can do that way, if there was a loss in the future and someone had some 30-year-old hot water heater they haven't changed, you could assess the cost back to that owner because they failed to follow the rules and regulations of the association. If you don't have those rules and regs and someone's hot water heater just bursts, the association is responsible for half the cost of the dry out, as we talked about before, plus any drywall related repairs. The unit owners will be responsible for floor coverings, wall coverings, cabinets, countertops. But yeah, you're getting on the hook. That's why you want to make sure your owners are abiding by updated rules and regs that require positive behavior. Same thing with the HVAC system. I strongly recommend having those automatic float switches installed if you don't have one. So if your system freezes over, it shuts off. It doesn't keep running and the water comes out of that and causes problems. So these are all things you can do to make your association a little stronger. Any other questions? All right, I think we got to the end of it. That took a good amount of time there. So thank you guys, appreciate it.
Thank you.
Any other questions? We'll still be here for a little bit.